Students, welcome to Sunil's tutorial. I'm Sunil Mirwani and today we'll be doing this chapter called as amalgamation. We're going to do question number 27. We're going to do question number 27 in the books of DT Limited. Okay. Now let's see this. They believe that preference dividend was in area rupees 40,000. The following scheme of reconstruction was duly sanctioned. A new company, TD Limited, was formed with 15 lakhs as authorized share capital divided into 1,50,000 equity shares of 10 each. The company would acquire DT Limited on the following conditions. Calculation of PC. Old company debentures were to be paid similar debentures in new company, and for arrears of interest, equivalent amount of equity shares to be issued. This is once I transfer the debentures. Next, creditors will be paid for every 100 of their claims 16 cash and 10 equity share in the new company. Again, this is see, when you're calculating PC, you have to only consider equity and preference. Besides that, nothing else is to be considered. And cash if they are giving you. Next, preference shareholders. For preference shareholders. Preference shareholders are to be paid 10 equity shares in new company for each share held by them in old company. Old, new. They are to be paid 10 equity shares in new company for each share held by them in old company. Now if you look at the preference shareholders, they are holding 2,500 shares. If you look at your balance sheet, the preference shareholders are holding 2,500 shares. That means they will be issued 25,000. So they will be given 25,000 equity shares of TD Limited at the rate of 10 each. So that's 2,50,000. Next, equity shares, equity shareholders. For equity shareholders, right? Now they are saying that for equity shareholders will be given 10 equity shares in new company for 3 shares held by them in old company. Old, new. They will be given 10 equity shares in new company for every 3 shares held by them in old company. Look at the balance sheet. There are 12,000 equity shares. So in that case, X will be 40,000. So they will be issued 40,000 equity shares of TD Limited at the rate of 10 rupees each. So that is going to be 4 lakhs, right? Expenses of 20,000 will be borne by the new company as a part of purchase consideration. The new company will take over current assets at their book value except stock, which will be reduced by 15,000. Intangible assets are not to appear in the balance sheet. Appropriate adjustments are to be made in the value of the assets. Remaining equity shares of the new company are to be sold to public. Let's start. First, let's do in the books of DT Limited. The seller. Journal. Right. First, transfer the assets. Realization account. Debit. 2. You're going to be transferring all the assets. So let's see this. Goodwill account to fixed assets to stock to debtors to bank balance. Right? Goodwill is 25,000. Goodwill is 25,000. Fixed assets are 12,85,000. Stock is 3,03,000. Debtors is 2,50,000. And bank balance is 7,000. Right? So someone please help me work this out. How much is this?
18 lakh
18,75,000.
70.
18 lakh 70. 18,70,000 being assets transferred. Next, let's transfer the liabilities. You have 9% debentures. You have 9% debentures account debit. Interest, accrued interest. Interest on debentures debit. Then besides that you have creditors debit to realization, right? 9% debentures, 9% debentures of 5 lakhs. Accrued interest thereon is 45,000. Creditors are 5 lakhs again. So you have 10,45,000 being liabilities transferred. Next, transfer the preference shares. Now, preference share capital is 2,50,000 and you will be issuing to them again 2,50,000. So this is going to be 8% preference share capital account debit. Preference share capital debit to preference shareholders. 8% preference share capital account debit to preference shareholders. Amount is going to be 2,50,000. Being preference shares transferred. Right? Once you finish transferring the preference shares, then transfer equity shares. So you will have equity share capital account debit. Equity share capital account debit. Then you have any reserves? No, you do not have reserves. Right? So this will be to equity shareholders. To preliminary expenses. Preliminary expenses to profit and loss. Right? Now, let's see this. Equity share capital is given to you as 12 lakhs. Preliminary expenses are 25,000. And profit and loss is 6 lakhs. Right? So that means 5,75,000 being equity shares transferred. Next, record PC. The new company is TD Limited. TD Limited account debit to realization. Right? How much is the PC you've calculated? 4 lakhs plus 2,50,000, 6,50,000. Being PC recorded. Receive the PC. Receive the PC, you're going to receive PC in terms of equity shares. So you will have equity shares of TD Limited debit to TD Limited. So amount is going to be 6,50,000. The PC received. Right? Once you have received the PC, the next thing that you need to do is pay the preference shareholders. So debit the receiver, preference shareholders are the receiver. So this is preference shareholders account debit. You're going to pay them by equity shares of TD Limited. You're going to pay them 2,50,000. 2,50,000 being preference shareholders paid. Right? Once you finish paying the preference shareholders, the next thing that you need to do is calculate the profit or loss. Someone just check this out. This is 18,70,000 minus 10,45,000 minus 6,75,000. Right? How much does it come to? 1,50,000.
So that is 6,50,000.
Which one is 6,50,000?
So the fifth journal entry, 6,75,000.
6,50,000.
The fifth one. That is
6,50,000. It's written 650.
No, what is 670?
Huh? 1,75,000 is the difference? Okay. Now this is, I presume, is a loss.
Yeah.
Right? So that means this will be equity shareholders account debit to realization. Right? Amount is 1,75,000, right?
Yes.
1,75,000 being loss transferred. Right? Once you finish transferring the loss, then pay the equity shareholders. So this will be equity shareholders account debit to equity shares of TD Limited. Right? They are supposed to be paid 4 lakhs in terms of equity shares. Being equity shareholders paid. So that finishes your journal entries in the books of DD Limited. Now, let's do in the books of TD Limited. Acquire business first. This is going to be business purchase account debit. To liquidators of DT Limited. Amount is 6,50,000. 6,50,000 being business acquired. Next, once you've acquired the business, take over assets and liabilities. So you will take over fixed assets, stock, fixed assets account debit, stock account debit, debtors account debit, bank account debit. Leave a line to 9% debentures of DT Limited to accrued interest to creditors to business purchase. Right? Now, they've said that the new company will take over current assets at their book value except stock, which will be reduced by 15,000. At the moment, the value of stock is 3,03,000. If I reduce it by 15,000, that becomes 2,88,000. So stock is going to be taken over at 2,88,000. Right? Other current assets are to be taken over at book value. That means debtors is going to be taken over at 2,50,000 and bank at 7,000. Right? Besides that, they have said that intangible assets do not appear in the balance sheet. That means goodwill is not taken over on the appropriate adjustments are to be made in the fixed in the values of fixed assets. Now, for appropriate adjustment, first of all, so I'll have to see at what value they are taking over the liabilities. Old company debentures will be paid by similar debentures in new company, and for arrears of interest, that means that is going to be taken over at the value that you had written. So debentures are going to be taken over at 5 lakhs. Debentures are going to be taken over at 5 lakhs. Accrued interest is going to be 45,000. Right. Next, regarding creditors, creditors are going to be taken over at. They are saying that creditors will be paid for rupees every 100 of their claim, 16 cash and 10 equity shares of new company. I'll just do this working note and find out how much is creditors. Working note, creditors, cash and equity. For every 100 rupees of claim, they are paying 16 rupees in cash and 10 equity shares. 10 equity shares. 10 equity shares of rupees 10 each. That means 100 rupees will be paid here, right? So for every 100 rupees, you will be paid 116 rupees. Creditors claim is 5 lakhs. Someone please get me the cash and the equity amount here. Someone please get me the cash and equity amount here.
80,000.
This is 80,000. Okay. And that is going to be 5 lakhs only.
Yeah.
Right? That means creditors is going to be taken over at 5 lakh 80,000. Business purchase is 6 lakh 50,000. The difference is going to be fixed assets. Someone please calculate the difference and tell me how much is the difference. And liabilities taken over. Someone get me the difference, people. Is the difference 2 lakh? No, 12 lakh
30,000.
30,000. 12 lakh 30,000. So fixed assets are going to be taken over at 12 lakh 30,000. Fine, do you get this thing here? Assets and liabilities are taken over. Next, I have to pay the PC. Debit the receiver. Liquidators of DT Limited debit. You are going to pay them with the help of equity shares. To equity share capital. 6 lakh 50,000. 6 lakh 50,000 being PC paid. Next, the first thing that you need to do is exchange the debenture. Old company debentures will be paid similar debentures in new company. So that means 9 debit what comes in 9% debentures of DT Limited debit to 9% debentures. You are issuing your own company's debentures, which is going to be debentures of 5 lakhs. Being debentures issued, debentures exchanged. Next, after you exchange the debentures, next thing they said that creditors for every rupees 100 of their claim. So pay the creditors. Let's see, debit the receiver. Creditors are the receiver. So creditors account debit to bank to equity share capital. Right? Creditors is 5 lakh 80,000. Bank is 80,000 and equity shares is 5 lakhs. Being creditors paid. Next, preference shares, so we've already done. Preference shares are to be paid, equity shares. Expenses of 20,000 will be borne by the new company as a part of purchase consideration, expenses. So that means you're paying, money is going out. So this will be goodwill account debit to bank. Amount is 20,000 being expenses paid. Right? So you finish paying the expenses. Next, the remaining equity shares in the new company are to be issued to public and are fully paid up. Now we have so far sold shares of 6,50,000. Acha, we had to pay something for arrears of interest also. For arrears of interest, equivalent amount of equity shares are to be issued, right? So write accrued interest account debit. Accrued interest account debit to equity share capital. 45,000 being accrued interest paid. Right? Now let's see how much worth equity shares have I issued already. 6,50,000 plus another 5 lakhs, 11,50,000, 11,50,000 plus another 45,000. So 11,95,000, whereas my authorized share capital is 15 lakhs, out of which 11,95,000 I have issued. So I can issue another 3,05,000, right? Issue, money is coming in. Bank account debit to equity share capital, right? Amount is going to be 3,05,000, right? Being shares issued, being shares issued, right? So that finishes all the journal entries there. Let's make balance sheet. Balance sheet. Liabilities, rupees, assets, rupees, authorized share capital. Authorized share capital, right in the beginning they said is 1,50,000 equity shares of rupees 10 each. 1,50,000 equity shares of rupees 10 each. That is 15 lakhs. Carry that off. Next, issued and subscribed capital. Issued and subscribed capital. Under issued and subscribed capital, you have issued entire 1,50,000 equity shares. So 1,50,000 equity shares of rupees 10 each. That's 15 lakhs again. Right? Let's move on to reserves and surplus. Let's move on to reserves and surplus. Amongst reserves and surplus, you don't have any reserves, right? Next, you have secured loans. Secured loans. In secured loans, you have 9% debentures. Of 5 lakhs. Then you have unsecured loans. There are no unsecured loans. Then you have current liabilities. Under current liabilities, you should have had accrued interest, which you have already paid off, and you should have creditors, which again have been paid off. So accrued interest and creditors both have been paid off. Fine. Next, let's move on to the asset side, guys. Fixed assets. Under fixed assets, you have goodwill, 20,000. Then you have other fixed assets. Other fixed assets. Goodwill, that was this goodwill. The goodwill that I'm purchasing company's goodwill. This goodwill is the amount that I have issued as expense. This is my realization expense goodwill. Right? Fixed assets. Fixed assets is 12,30,000. Right?
So but it says intangible assets are not to appear in the balance sheet.
Intangible assets are not to appear in the balance sheet means intangible assets of the company that I'm going to take over. This is an expense that I've incurred. How do I account for this expense? Right? Why did I pay that 20,000 extra? I must have agreed to pay 20,000 extra for the name. I did not. Their goodwill was 25,000, which I have not taken over, which I'm not recording also in the book. That's the reason this line that I left blank, I didn't use that only. When any expense, suppose had there been some reserve created, that also I would have recorded. So what is created in my books, I can record. Intangible assets not to appear in the balance sheet means what I'm taking over, that is not to appear in the balance sheet. Okay. Next, investments. Under investments, do we have investments? No. Then you have current assets. Under current assets, you have fixed current assets. You have stock, which is 2,88,000. Then you have debtors, which is 2,50,000. Then you have bank, which is 7,000 minus 80,000 minus 20,000 plus 3,05,000. Someone please get me the bank figure. 2,12,000. Right? Tally the balance sheet and see if it tallies.
20 lakhs.
20 lakhs. Right? That finishes that sum. We'll stop this here for the day. Thank you very much.